Credit Suisse has switched China and Thailand with India and Australia in their portfolio. This is after the Asia strategy, and Dan is here to speak with us on this and share with us some of the rationale behind it as well. Dan, great to have you with us, and of course we love hearing that India is now being looked at more closely. Would share with us a little bit what you're finding the most exciting when it comes to the opportunity here in the Indian market. Has this been a call post the budget and post the government setting intentions? Has it been based on the economic recovery?
It's based on a number of factors. I'd say the most important issue is that India is very well positioned from a cyclical perspective. India is just heading into what we think will be a very strong recovery from the COVID pandemic. We switched from China. China already is largely recovered from the pandemic. If you look at its economic indicators and its earnings, they're pretty much normalized, whereas India was hurt quite badly by the pandemic last year, but seems to be coming out of it now, and we think there's going to be a very strong cyclical recovery. On top of that, you have some other strengths for India. The earnings momentum is very good. There's among the best earnings growth in the region. Revisions from the street are among the strongest in the region. And India also potentially has one of the best stories on interest rate cuts in the region. Most other countries in the region, interest rates are probably at the bottom, whereas in India, they can continue to come off.
Okay. Everyone always focuses on the financial segment here in India as a key or as a metric going forward. In terms of the credit cycle, and the way that we are seeing some of the major financial names sort of manage and come through this difficult period. What's your sense in terms of where we're at in the pickup in that cycle?
Well, I think India is well positioned here as well. India's credit cycle is running ahead of the credit cycle for most of the rest of the region. We've been seeing credit costs, loan losses rise in banking systems throughout the region. India had its peak in loan losses actually before the pandemic hit. It's been seeing declines in loan loss provisioning from the banks in the 1 to 2 years before the pandemic hit. And this tailwind from coming out of that previous credit cycle is more than offsetting the headwind from the pandemic itself. And that means that India's banks, I think, are better positioned in the cycle as far as loan losses and as far as credit growth is concerned than banks elsewhere in the region.
Dan, hi there. I wanted to also understand, how much really the pandemic situation is weighing in on this entire equation, because now everyone's talking about a potential second wave, and that, of course, is going to wreak havoc. Is that being baked into this assessment, and how much of a concern or a worry is that for the growth prospects for the country?
We're definitely concerned about a potential second wave in India, but it's not just an India-specific issue. We are having second, third, fourth waves around the planet, and I don't think any country is immune from a potential worsening of infections. What I can say about India is that we do have seroprevalence studies which indicate that India is closer to achieving herd immunity than most places on the planet, especially in large population centers. India also has, I think, a bit of an edge in vaccination strategy as compared with other developing countries. Now, clearly, the developed markets like in the US, the UK, are going to be vaccinating themselves more quickly than a developing country like India. But as compared with other developing markets globally, I think India has an advantage in that it has this large domestic contract manufacturing industry in pharmaceuticals, which enables it to bargain hard with the global pharmaceutical majors and get a big cut of vaccine production. So I think India, yes, there are risks, but if you compare India's risks with other markets in the region, I think they're actually less.
Point taken. And Dan, what's the outlook in terms of how you've read into the latest policy actions by the Reserve Bank? Latest, we did have that, the RBI holding on to their rates. What is it that you're expecting by way of movement of the bond yields as well as action from the Reserve Bank going forward?
Well, it is going to be hard to forecast where RBI goes, given that a lot hangs on non-core inflation. The main problem that we've had on the inflation front is the non-core items, which are very difficult to forecast. They can go in any direction. What I can say is that there's at least as much chance that non-core inflation will be more tame going forward than it's been over the past 6 months. We as a house think that energy prices are probably peaking around now. It's harder to say where the food prices will go. We can also say that another potential impediment to lower rates is no longer an issue, and that's the external accounts. The current account has improved dramatically. The balance of payments is in the major surplus. This isn't going to be an issue. So if we get a little friendly movement on the food pricing, then I think RBI can move back into cutting mode.
Right. Dan, wanted to get your perspective and a little away from India as to what is it that you're making of, the surging US bond yields? Because that would then question whether emerging markets are the best investment bet in the current environment, and that could be a potential risk.
It is something that we have to watch, and I think that rising inflation expectations are one of the main forces for global equities right now, but we consider it a force for good at the current levels. Typically, rising inflation is positive for global equities up to about 3% inflation in the US. We're not there yet. We've got plenty of headroom before we get there. If you look at how emerging Asian markets behave in times of rising inflation at low levels like we're at present, typically higher inflation is good for emerging Asia, India included. India, I would not say, is one of the top beneficiaries, but in general, it's good for emerging markets. Why might that be? Even though typically higher bond yields would be bad news, all other things being equal for emerging markets, it's because it's a reflection of faster growth and emerging markets in Asia. These companies are generally price takers, not price givers. And in an environment of rising prices, it gives companies pricing power, and you see margin expansion and rapid earnings growth. So at the current level, bottom line is we think higher inflation and a bit higher bond yields will be actually a good thing. But you can get too much of a good thing if we go beyond, say, 1.5% bond yields in the US or 3% inflation. That's when we start to get worried.
Sure. I'm curious to know why you think China is not such a good thing anymore, and the exciting period of China's recovery has passed.
Well, I should emphasize that our downgrade of China is a relative call. We think that there are better opportunities in Asia, but it's not saying that we think that China's rally is over. We think that out here in Asia, we've got an embarrassment of riches with a lot of good markets and stocks to choose from, and we are simply going with places that we think will be performing better than China going forward. As I said before, the main issue for China isn't that we think it's going to be heading into a slowdown. It's just that other markets are going to see a more rapid catch-up with China over the coming year. You've got these better opportunities in places like Korea, in India, which haven't had as strong a recovery as China over the previous 6 months, which enables them to have a bit more headroom going forward. So not saying China's bad, it's just that it's not as exciting as some other places.
All right, Dan, great speaking with you. We'll leave it there this morning. Thanks for joining us. Time for a very quick break. We'll be back in just a moment.